Welcome to Intelligent Investor Insights with Joshua and Robert Barone. They're your co-hosts and guides through the noise of today's markets. Here, we interpret the data behind the headlines, break down what's driving the economy and interest rates, and help serious investors make decisions rooted in clarity, not emotion. If you're looking for disciplined, research-driven insight to strengthen your portfolio, you're in the right place.
I'm Bob Barone, or at least the AI version who drinks less coffee, but still worries about the Fed. And I wish I could tell you the data landscape is clear. Instead, we're stuck with the economic equivalent of a GPS that keeps saying, recalculating. The shutdown pushed jobs data off the map, postponed inflation reports, and left the BLS running at about 75% capacity. If you were hoping for clarity, you might want to dial back your expectations.
Josh here. Now, the Fed is headed into its big December meeting just swinging in the wind. The odds of a rate cut, if you'd asked me or any market observer a month ago, were at 95%, near certainty. Now, it's a coin flip, plain and simple, 50-50. And that's not just my estimate. Check the market odds. There's nothing like missing half your dashboard instruments when you're trying to land a plane in a storm, which is what the Fed is up against right now.
You know, this isn't even the first time this has happened. I always remember the early 1990s. Now, I might mess up the specific year. Was it 90 or 91? Let's say it was around there, when policymakers had to rely on private data because government releases just weren't available. I'm not kidding. They actually wound up making a pretty terrible rate decision. They trusted the wrong estimates, and the Fed was forced to make a call basically blind. It did not work out well. That lesson sticks with you, especially if you're still feeling the market scars. Frankly, when the official numbers get shaky or disappear, central banks start guessing. And you don't want monetary policy built on guesswork. All right, let me shift to the labor market and the so-called strong consumer. We hear a lot about how resilient the economy is or how robust job growth remains. Frankly, I don't buy it. This month's numbers from ADP and the folks at Challenger Gray and Christmas paint a desktop image that's anything but rosy. October alone, over 153,000 jobs cut. That's up 183% from the previous month. Even if you're not a numbers person, that's a staggering leap. The ADP data shows the private sector losing jobs every week in October. More than 11,000 a week vanished. If the media is giving you a steady strength headline, they're cherry picking or worse.
And it isn't just jobs. Let's talk delinquencies. Record high unpaid credit card balances, about $4,200 per capita. Auto loans, 5% of balances are 90 days late, the worst since 2011. Credit cards, newly delinquent loans are at their highest rates since 2014. Seriously delinquent loans, those that are 3 months overdue, have hit a 12-year high. Student loan delinquencies, 14%. None of this says healthy consumer. When delinquencies spike like this, it's a blaring warning sign. You don't need a PhD from Georgetown to see which way the wind's blowing. Recession odds, in my view, are now quite high.
And here's a personal gripe. Payroll reports and headline unemployment figures. People love the big, comforting number. Look, unemployment is only 4.3%. But if you've ever peeked under the hood at household survey data, you'll see there's a gap that showed up before the Great Recession in 2007, by the way. It always bugs me how policymakers and the media gloss over that. I'm telling you, when the household survey starts diverging that sharply, optimism in the payroll report is almost always misplaced. Now, you might hear the market's up, and technically that's true over the past couple of years. S&P 500 sitting up 14% year to date, 23% in 24. But dig a little deeper and it's less comfortable. The market's been, you could say, pausing. Maybe it's waiting for those big AI-powered profits to materialize. But let's be honest, that sort of payoff takes years if you see it at all.
While the headlines still want to talk about tech optimism, real people, especially consumers, are anxious. The University of Michigan Consumer Sentiment Index for November, 50.3. That's the second lowest in the history of the index, going back to the 1950s. Only November of 22 was gloomier. The current conditions index fell off a cliff. Consensus was close to 60. Reality was 52. That's not a small miss, folks.
And here's the kicker nobody wants to talk about. Nearly 43% of New Yorkers fear they'll lose their job in the next year. 43%. That's not anecdote, that's the data. How that isn't part of every mainstream analysis is beyond me. Meanwhile, the housing market's limping along, and buying conditions across the board look pretty grim. For all the soft landing cheerleading, what we've got is consumer anxiety piling onto a fragile market structure, and it's not getting the attention it deserves. So let's wrap it there. The data is thin, the risks are rising, and investor optimism feels a little detached from reality. You can't navigate with your eyes closed. Next time we'll keep digging, especially as more actual numbers, hopefully, come back online. Until then, keep your skepticism sharp and your eye on the signals that matter.
Thanks for joining Robert and Joshua on Intelligent Investor Insights. If today's discussion raised questions about your portfolio strategy, risk exposure, or how to navigate this late-cycle environment, we invite you to connect with us. We work directly with investors who want data-driven guidance, institutional-level analysis, and a partner in building durable wealth. Reach out to start the conversation and take the next step toward becoming a more informed, confident, and resilient investor. Until next time, stay rational, stay disciplined, and invest with intelligence.